Hi everyone. Welcome to Listen2Riches, listen your way to financial freedom. In this channel, we share in-depth insights about wealth wisdom to help you grow your way to riches. Our main goal is to bring you wealth by listening to books. Before we start, do not forget to subscribe and like our channel and share it with your friends. In this way, we will be able to continue to bring you more valuable content and let more people benefit from this valuable book. I wish you all a pleasant listening time. Today, let's delve into the intriguing realm of the psychology of money, timeless lessons on wealth, greed, and happiness, a captivating book authored by Morgan Housel, who used to write about finance for the Wall Street Journal. Since its introduction in September 2020, The Psychology of Money has offered us priceless wisdom. Revisiting this book in 2023 after my initial encounter in 2020 has led me to gain fresh and equally meaningful insights. This book proves to be especially advantageous for making smarter financial choices and gaining a clearer understanding of our economic surroundings. Beyond that, it imparts wisdom that often outshines the advice found in many specific investment and financial guidebooks. But why is this the case? Let's step into a story from the book. We're all familiar with the investing guru Benjamin Graham and his influential work, The Intelligent Investor. This book, often hailed as the Investor's Bible, not only imparts theoretical knowledge but also practical formulas for successful investing. When Housel was young, he was greatly drawn to these formulas. They seemed like a surefire path to wealth if followed diligently. However, as he accumulated more experience in investing and deepened his understanding of the field, Housel realized that these formulas and guidelines couldn't be applied rigidly. For example, one of Graham's principles advises cautious investors to steer clear of stocks trading at over 1.5 times their book value. Yet, if you stuck to this rule in the US stock market between 2010 and 2020, your options would be limited to insurance and bank stocks. This indicates that the effectiveness of this rule has diminished. Moreover, if we examine the different versions of The Intelligent Investor that Graham revised 5 times between 1949 and 1972, it becomes evident that the final version wasn't confirmed by 1972. The question lingers until the end of our discussion. Many specific tidbits of knowledge and formulas found in investment and financial books have constraints tied to time and context. Therefore, Housel suggests that we focus more on understanding universal principles. These include the inherent greed and fear ingrained in human nature, how our minds react under pressure, and the process of mental recovery after experiencing financial shocks. Housel has a soft spot for a quote by Voltaire. "History never repeats itself, but man always does." He finds this quote particularly relevant to our financial behaviors. Consequently, Housel takes pleasure in exploring human nature and the psychological rules that underlie the history of money. He ponders how we can harness these insights to our advantage. In this audiobook summary, we will explore the key insights and lessons from each of the book's 20 chapters, providing you a comprehensive overview of the book's core ideas from the power of compound interest to the role of luck in personal finance and investing. Let's begin. The first lesson is that no one is crazy. Housel claims that the personal experiences we've had with money account for a tiny fraction of what's occurred in the world. But remarkably, these experiences shape about 80% of our perception of the world. Housel's idea is that our feelings about money are rooted in the interactions we've had with it before. Everyone's had different experiences, which is why when you witness someone making a money choice you wouldn't, it's important not to be quick to judge. That person's past encounters have guided them to that decision. For example, Americans spend more on lottery tickets than on movies, video games, music, sports events, and books combined. Who tends to play the lottery? Mostly those who are less well off. The poorest American households spend about $412 per year on lottery tickets, a sum 4 times greater than the richest households. Those spending hundreds on lottery tickets are often the same people who struggle to save $400 for unexpected expenses. They're trading their safety net for a slim chance of winning big. If you step into the shoes of the most financially challenged, you start to grasp that, for them, the lottery ticket is a logical choice. It's their only shot at the kind of opportunities you take for granted. They're paying for a dream that's hard to understand because you're already living it. And that's why those with fewer means buy more lottery tickets than you might. Nevertheless, Housel urges caution. He advises against basing financial decisions solely on past experiences. Instead, he encourages making choices based on goals and objectives. The second lesson revolves around luck and risk. Housel emphasizes that events beyond your control will wield more influence over your investments than any intentional actions you take. To illustrate this, he turns to the story of Bill Gates. Much like the point Malcolm Gladwell made in his book, Outliers, Bill Gates is undoubtedly brilliant and put in immense effort. Yet, he also had the fortunate circumstance of attending a rare school equipped with a computer at a time when such opportunities were scarce. This bestowed upon him a notable advantage. There was an element of chance there. Without it, there might have been no Microsoft or Bill Gates, the wealthiest individual globally. Housel underscores the significance of this luck factor. To counteract its impact, he advises focusing on strategies that have proven effective for a wide range of people, rather than attempting to replicate the extraordinary fairy tale success of someone like Bill Gates. Lesson 3 is all about recognizing when you have enough. Housel shares an interesting observation that often it's wealthy individuals who engage in extravagant, money-related behaviors. The reasoning behind this is that once they accumulate wealth, their objectives shift. They become driven by an insatiable desire for more, often jeopardizing what they've already earned in the process. Housel stresses the importance of identifying when you've attained a sufficient level and making prudent choices. The key lesson here is to avoid jeopardizing what you have and require for the sake of pursuing something unnecessary that you merely want. Don't get too attached to anything fame, achievement, or the like. If one thing has unjustly ruined my reputation, it only bothers me if I cling to my reputation. Lesson 4 emerges as a particularly emphasized point in the book, and it revolves around the concept of compounding and compound interest. Housel firmly asserts that the incredible power of compounding can be hard for the mind to fully grasp. In essence, this is the core of Housel's guidance. The secret to successful investing lies in giving it the gift of time. As an investor, achieving extraordinary returns isn't the necessity. What truly matters is to secure reasonable returns consistently over an extended period. This is the pathway to accumulating wealth. Housel turns to the example of Warren Buffett to illustrate this idea. Buffett, now over 90 years old, boasts a personal fortune exceeding $80 billion. However, his investing journey began at the tender age of 10, and more than half of his wealth was amassed after he turned 50. Housel's strong conviction lies in the transformative potential of compounding, a force that can pave the way to financial liberation. Lesson 5: Becoming and Staying Wealthy. Here, the author explores the distinctions between gaining riches and maintaining them. The central argument is that many people concentrate on amassing wealth, overlooking the equally essential aspect of keeping it intact. This oversight can lead to financial downfall in the long haul. Housel delves into the idea that the path to gaining wealth often involves embracing risks and making daring investment choices. However, the path to retaining wealth demands a distinct mindset, one centered on safeguarding and nurturing one's financial assets across time. He observes a trend: swift accumulators of wealth frequently become swift losers of it, largely due to inadequate financial oversight and high-stakes investments. Housel places paramount importance on diversification and risk management in the preservation of wealth over time. He underscores that successful investors comprehend the delicate balance between risk and reward, and they adopt a panoramic perspective of their investments. Throughout this chapter, Housel encourages readers to think beyond just amassing wealth and to focus on maintaining it over the long term. He stresses the significance of devising a solid plan and adhering to it, exercising patience, and displaying discipline in financial choices. By embracing these principles, readers can construct and uphold wealth over extended periods. In Chapter 6, the author delves into the idea of extreme events, or tails, in the world of investing and personal finance. The core argument is that while these occurrences are infrequent, they wield a substantial influence on financial results. Consequently, they must be factored in when making investment choices. Housel clarifies that tail events encompass those that fall way beyond typical expectations. These extraordinary incidents can yield both highly favorable and severely unfavorable consequences. For instance, think of a sudden stock market crash or an unexpected surge in stock prices. The pivotal takeaway is understanding the potential impact of these extraordinary events on investing and personal finance. While pinpointing when these events will occur is essentially impossible, it's crucial to be primed for them. Housel underscores the importance of diversifying investments and adopting a long-term perspective as safeguards. Housel encourages readers to prioritize risk management and readiness for these rare events rather than attempting to foresee them. He highlights that savvy investors acknowledge the possibility of such events and take measures to shield themselves against their ramifications. Chapter 7: Freedom. In this chapter, the author dives into the notion of financial freedom and its profound influence on life. The core argument stresses that financial freedom isn't solely about amassing a substantial fortune, but revolves around the power to make choices and lead life according to one's own wishes. Housel unravels the multiple avenues through which financial freedom can be attained. It isn't merely reliant on possessing a hefty bank balance, but rather can stem from a steady income, a well-rounded investment portfolio, and the ability to manage expenses below earnings. The fascinating twist here is that what might appear as a distant aspiration can actually be well within grasp for most people with the right mix of self-control and perseverance. Central to this philosophy is the art of living within one's means and sidestepping the trap of lifestyle inflation, which can be a stumbling block on the path to financial freedom. By focusing on life's true essentials and consciously directing expenditures, anyone can edge closer to this coveted state. Throughout this chapter, Housel encourages readers to cultivate a life in alignment with their core values and priorities, rather than a single-minded pursuit of wealth. The resonating message is that financial freedom transcends monetary riches. It is about the liberty to carve out the life one envisions. Lessons number 8 and 9 also focus on changing your perspective. In Lesson 8, we explore the man in the car paradox. Imagine seeing someone driving a luxurious Ferrari. Instead of thinking, I want to be friends with that person, most of us think, I want to be that person. It's common for people to chase wealth in hopes that it will garner others' admiration. However, what often happens is that others aspire to replicate their lifestyle, which is quite distinct. Lesson 9 is centered on smart spending. Housel contends that real wealth often lies behind the scenes. It isn't about flashy watches or extravagant cars primarily. Housel offers a valuable piece of advice: don't measure a person's wealth by what's visible or the things they own. He emphasizes that true wealth is the freedom to buy more than what you can at present. In Lesson 8, it's about realizing that pursuing wealth just to impress others can lead to a different kind of admiration. Lesson 9 underscores the significance of discerning genuine wealth, not in the possessions, but in the capacity to make choices beyond the present limitations. In a similar vein, Lesson 10 underscores the value of detaching your ego from your financial decisions as a means to save money. The advice is simple: avoid spending on unnecessary items just to keep up with others, a phenomenon often referred to as keeping up with the Joneses. Housel introduces a formula to encapsulate this notion: savings equals income, ego. When you define savings as the difference between your ego and your income, you realize why many people with decent incomes save so little. A daily battle against instinct is to stretch your peacock feathers to the limit and keep up with others who are doing the same. Returning to the idea of adaptability, Housel emphasizes its importance. Accumulating greater savings and trimming expenses by removing the ego-driven spending factor can result in enhanced flexibility. This newfound financial flexibility might translate to the ability to work fewer hours or for a reduced wage in a job that ignites your passion. It might also open doors to investing in opportunities that were previously beyond reach. Lesson 11 is about being reasonable rather than always being rational. The same as with dieting. The most sound strategy is one you can maintain. There is a social aspect to investing that we forget, and sometimes it's impossible to always be coldly rational. There is a well-documented bias towards the home. People invest in the companies of the country they live in while ignoring the other 95% of the planet. This would not be rational until you consider that in investing you are effectively giving money to strangers. If familiarity helps you make the leap of faith necessary to continue to support these aliens, then the bias towards the home is rational. Choose a strategy that you can stick with instead. Lesson 12 is about surprises. Scott Sagan, a professor at Stanford University, once shared a thought that should hang as a reminder for everyone navigating markets and investments. Things happen all the time that have never happened before. Placing excessive reliance on the history of investments might lead you to overlook the significant exceptions that hold the most importance. The trajectory of investment history might not always guide us accurately toward the future of the economy and stock market. This is due to its inability to accommodate current structural changes that hold relevance. A captivating aspect of investment history is that the farther back you trace, the more likely you're observing a world that doesn't quite mirror today's reality. Many investors and economists find solace in the vast data from decades, or even centuries, past that supports their projections. However, with the evolution of economies, the history of recent times often proves to be a better compass for the future. It's more likely to encapsulate pivotal conditions that maintain relevance moving forward. The right lesson to draw from surprises is that the world is full of surprises. It is not that we should use past surprises to delineate the boundaries of the future. We simply need to acknowledge past surprises and the fact that we have no idea what might happen next. This also leads on to Lesson 13, where Housel states you need to leave yourself additional space to recover from mistakes or unforeseen circumstances. If you want to be in the game for the long run, you need to leave room for error. Room for error lets you endure a range of potential outcomes, and endurance lets you stick around long enough to let the odds of benefiting from a low-probability outcome fall in your favor. A big gap in most people's understanding of room for error is accepting that there is a difference between what you can technically endure versus what you can emotionally endure. For example, maybe you have enough money saved up to last you 2 years. So maybe you quit your job to pursue your dreams, assuming that you can always get a job when you get closer to $0 in savings. Technically, you can do this, and you won't even be in debt. But perhaps emotionally, you start getting nervous after you've burned 30% of your savings, and all of a sudden you're depleted psychologically. If that's the case, you may ditch your dreams and go back to a day job even if you had another year's in financial runway. So if you don't account for your emotions in your models, you may end up in suboptimal situations. Lesson 14 states that you'll change over time. So make sensible goals because in 5 or 10 years you won't necessarily want the same things as you want now. But many of us grow so much over a lifetime that we don't want to do the same thing for decades. That said, compound interest works best when you allow years, if not decades, for growth. This is true not only for savings but also for careers and relationships. Persistence is the key. Lesson 15 suggests that everything has a price, and just because you can't see it, it doesn't mean you won't end up paying it. Everything has a price, and the key to a lot of things with money is just figuring out what that price is and being willing to pay it. The problem is that the price of a lot of things is not obvious until you've experienced them firsthand, when the bill is overdue. The question is, why do so many people who are willing to pay the price of cars, houses, food, and vacations try so hard to avoid paying the price of good investment returns? The answer is simple. The price of investing success is not immediately obvious. Lesson 16 is about being aware of who you are taking financial advice from. It's very hard to apply the advice of someone who has different amounts of money or different goals to you. It's hard to understand that other investors have different goals than we do. It is difficult to justify paying $700,000 for a 2-bedroom house in Florida in which you plan to raise your children, but it is perfectly logical to buy the same house if you plan to outsell it in a few months in a market with rising prices. What you don't realize is that the traders who set the share price were playing a different game than you. $60 for a share was an acceptable price for the trader because he planned to sell the shares before the end of the day when the price was likely to be higher. But $60 was a disaster for you because you wanted to hold the shares for the long term. It won't work in the end. Instead, look at the average and do what works for people in your situation in general. The most important thing I can recommend is to do your best to find out what game you're playing. Lesson 17 is to be optimistic. That will help you stay in long term. Pessimism often sounds smarter and more persuasive than optimism. If something is not going well, it's easy to think that it will continue not going well. And that sounds very plausible. But what this line of thinking misses is that problems often create demand for change and solutions. And this leads to ingenuity that creates changes that only the optimist might believe in. In Lesson 18, Housel states that markets are influenced by stories. Housel uses the example of World War I. It was the war to end all wars. No one wanted to see suffering like it ever again. However, the truth was that another war was right around the corner. Housel warns you not to delude yourself. In 2007, we told a story about the stability of house prices, the prudence of bankers, and the ability of financial markets to accurately price risk. In 2009, we no longer believe that story. Only that has changed. But it changed the world. Once you choose a strategy or a solution, you invest in it financially and mentally. If you want a particular stock to go up tenfold, growth stocks become your tribe. If you think a certain economic policy will cause hyperinflation, that will be your side. Lesson 19 is the recap of all the 18 chapters. Let us go through one by one about what we've learned about the psychology of your own money. Embrace humility during the good times and forgiveness during setbacks. It's a fundamental truth that things are never as amazing or as dreadful as they appear. Recognize the potency of luck and risk. Doing so will steer your focus towards elements you can genuinely manage. Additionally, it will guide you towards finding apt role models. Trim ego, amplify wealth. Money saved bridges the gap between what you want to project and what you earn, while genuine wealth lies in what remains unseen. Sculpt your financial approach to bring you peace when you lay down to rest. For a brighter investment path, the most influential move is to extend your time horizon. Cultivate resilience in the face of adversities. Utilize money as a tool to secure command over your time. Relinquishing control over time is a substantial and universal damper on happiness. Strive for kindness over flashiness. Remember that the admiration your possessions attract in others rarely matches the significance they hold for you. Save. Simply save. A specific rationale isn't a prerequisite for saving. Define the toll success demands and be prepared to pay it, for valuable achievements come at a cost. It's crucial to acknowledge that many financial prices lack visible labels. Uncertainty, hesitation, and remorse often tag along as costs in the realm of finance. Give reverence to the possibility of mistakes. Steer clear of extremes when making financial choices. Embrace risk for its long-term rewards, but be cautious of ruinous risk that can halt your ability to take calculated future leaps. Articulate the game you're partaking in, ensuring your moves aren't influenced by those in a different arena. Appreciate the intricacy of finance. Savvy, informed individuals can hold differing views due to their diverse aspirations and desires. In the world of finance, there's seldom a singular correct answer. There's only an answer tailored to your unique circumstances. In the final lesson, the author explains his own investment strategy. His purpose is to be financially free so he doesn't depend on a job and can do whatever he wants. He owns his house without a mortgage, which is financially bad, but emotionally good. 20% of his money is in cash so he can face a financial emergency. The author invests in low-cost index funds as he knows that merely picking stocks and beating the market is really hard. This is the end of this book summary. Congratulations on finishing another book. If you like to check out other book summaries, please subscribe to Listen to Riches. Also like and share this valuable knowledge with your friends. Let us combine wisdom with practice to achieve our financial goals and create a better future. Thank you, and see you in my next video.